If you're staring at the New York chart right now and thinking, okay, silver at $71, we're winning, I need you to understand something. You're not watching the market. You're watching the rearview mirror. The future is not in the green candle on COMEX. The future is in the only place where physical metal is being fought over with industrial urgency. And that is why I'm about to say something that will sound insane to anyone still living in the spot price fantasy world. Tomorrow, Thursday, silver can trade at $78 or higher in Shanghai. And no, this is not a magical prediction. This is not hopium. This is not vibes. This is what happens when three forces lock into alignment and turn the silver market into a pressure machine. The accelerator, the time compression of the rally, and why it matters more than any technical indicator. The engine, the arbitrage gap, the spread between paper price and physical price, and why it drains the West like a vacuum. And the trigger, the $75 to $80 zone as an options gamma minefield, plus the industrial supply panic that makes price jump without asking permission. In this breakdown, I'm going to show you the cold data on time compression and why it proves the market is accelerating, not trending. I'm going to explain the arbitrage mechanics and why the Shanghai premium isn't closing, which tells you everything about physical scarcity. I'm going to detail why Shanghai is now the real price discovery mechanism, while New York trades ghosts. And I'm going to give you a 5-point checklist, what to watch in the next 24 hours to validate the $78 plus thesis in Shanghai. Take a breath. Because if you're still anchoring to New York, you're about to get blindsided. The real market moved east, and the price you're watching is already outdated. This is the story of why $78 in Shanghai tomorrow isn't speculation. It's the future arriving faster than Western paper can pretend otherwise. Let's start with cold data. No opinions, no narratives, just the clock. Time for silver to go from $40 to $50, 39 days. Time from $50 to $60, 12 days. Time from $60 to $70, 13 days. Do you see the anomaly? The market needed 39 days to make the first $10 move. Then it made the same $10 move in 12 days. Then it made the next $10 move in 13 days. That is not normal price discovery. That is what a market looks like when the price stops being negotiated and starts being re-rated by urgency. Because once time compresses, the market changes personality. It stops asking what's fair value and starts asking how fast can I get it. Now here's the question that matters. If this market is already capable of printing plus $10 in approximately 12 to 13 days when the engine is running, how long does it need to go from $70 to $80? And here's the part most people don't understand. The $70 to $80 stage is not equal to the earlier stages. It usually happens faster, for 3 reasons. Reason number 1, psychological. $70 triggers headlines, $80 triggers panic plus FOMO simultaneously. $80 is where normal people stop thinking in charts and start thinking in consequences. This is my retirement, this is my savings, this is the thing I should have bought 6 months ago. The psychology at $80 is different than at $60. It's urgent, it's emotional, and emotion accelerates moves. Reason number 2, mechanical derivatives. Big round strikes concentrate hedging and forced buying. If you're near $75 and $80, you're near the gamma gears. These are the levels where options market makers have to hedge aggressively, and their hedging becomes buying, and their buying pushes price higher, which forces more hedging. This is not speculation. This is how options markets function under pressure, and we're approaching that pressure zone. Reason number 3, physical supply chain. Above certain levels, industrial buyers stop negotiating price and start negotiating delivery, meaning the question shifts from what's the price to can you deliver, yes or no. This is the most important shift. Because once delivery becomes the constraint, price becomes secondary. And when price becomes secondary for buyers with deep pockets, price discovery breaks. It doesn't trend, it jumps. So when someone says $80 next week, you don't respond with emotion. You respond with the only thing that matters, the speed of the prior moves. If $50 to $60 took 12 days and $60 to $70 took 13 days, then a $70 to $80 move in 7 to 10 days is not fantasy. It's simply continued acceleration, especially if Shanghai is pulling the rope. And that brings us to the real point. Shanghai is the clock. Not New York, not London, Shanghai. Because Shanghai is where physical demand meets physical supply. And in a deficit market, physical sets the price. Always. Let me explain why this matters. Here's the most important rule in commodities, in 2 lines. In a surplus market, paper sets the price. In a deficit market, physical sets the price. When the world is short on metal, the real price is not what your app shows. The real price is what factories pay to avoid shutting down. So what does it mean when Shanghai rises and holds a price above the West? It means this: the arbitrage gap becomes a magnet. If New York prints $71, but Shanghai prints 75, 76, 77, that spread looks like free money to anyone who can move metal, buy cheap in the West, Sell expensive in Shanghai, pocket the spread. This is classic arbitrage, risk-free profit. Traders do this all day long in functioning markets. But here's the fatal detail. Arbitrage only works if the cheap market actually has metal. And in a physical squeeze regime, the cheap market becomes paper cheap. It's cheap in theory, it's cheap on screens, it's cheap in contracts. But in delivery terms, it's a ghost. So now you get the most dangerous situation in finance. A premium that doesn't close. In part 2, we're going to explain why this premium persistence is the single most important signal in the silver market right now. Because when arbitrage breaks, control transfers, and the West is losing control. Stay with me. We're going into the mechanics of the drain. If you're just joining us, we've established that silver is moving in time compression. Each $10 move is happening roughly 3 times faster than the previous move. And we've shown why the $70 to $80 move can happen even faster than 60 to 70. In part 1, we covered the tempo. In part 2, we need to understand the arbitrage gap, because this is the engine that's draining Western vaults and transferring price control to the East. Let me explain how arbitrage is supposed to work. Because if arbitrage was functioning normally, the gap would snap shut quickly. Buying in New York pushes New York up. Selling in Shanghai pushes Shanghai down. The prices meet, the spread closes, equilibrium restored. This is market making 101. And it works in most commodities most of the time. But when Shanghai does not come down and the gap does not close, that signals something extremely specific. Physical demand is eating supply faster than logistics can refill it. And that's how you build the $78 thesis for tomorrow. If Shanghai is already paying future pricing today, tomorrow it can simply step higher again, because the West cannot ship metal fast enough to cool the premium. And when the premium doesn't cool, it attracts more flow, and that creates a loop, a vicious one. Let me walk you through what's happening right now. Step 1, Shanghai opens. Physical buyers in China need silver for solar panels, for electronics, for industrial applications. They bid. The price rises to $75. Step 2, traders in the West see the opportunity. Buy silver in New York at $71, ship it to Shanghai, sell it at $75, profit $4 per ounce minus shipping and insurance. Let's say net profit is $2.50 per ounce. That's attractive. So they execute the trade. Step 3, they go to buy the metal in New York. But here's where it breaks. The metal isn't readily available. Registered COMEX inventory is low. Dealers are on allocation. Refineries are backed up. They can get paper contracts easily. But physical bars, delayed, or unavailable at the size they need, or only available at premiums that eat into the arbitrage profit. Step 4, without sufficient Western supply flowing east, the Shanghai premium doesn't collapse. It persists. And as it persists, more buyers try to exploit it. But they all run into the same problem. The cheap metal isn't actually available for immediate delivery. This is the signature of a broken arbitrage bridge. And when the bridge breaks, the premium becomes a one-way signal. It's not saying silver is expensive in Shanghai. It's saying silver is scarce everywhere. But Shanghai is the only market honest enough to price it correctly. Let's turn this into a practical model. For Shanghai to print 78 plus tomorrow, 3 conditions need to be true, not mystical, observable. Condition A, the gap stays open or widens. If Shanghai continues paying above the West, the market is telling you physical is worth more than paper. Condition B, physical flow cannot respond fast enough. If metal doesn't arrive in time, the premium rises, simple supply and demand. Condition C, the $75 to $80 zone flips into industrial panic mode. That's when the question becomes delivery, not price. And this is where 78 plus becomes dangerous. Because once factories start bidding like it's an auction, you don't get a slow climb. You get steps, you get jumps, you get no trades in between. This is how commodities behave when scarcity becomes obvious. Price doesn't trend, price resets. Now, a lot of people will say, if Shanghai is 78, why isn't New York 78 right now? Great question. Because the West is still trapped in the paper theater. Paper has shock absorbers, massive sell walls in the order book, smash events and thin liquidity, rollover tricks, swaps, and most importantly, derivatives that push the problem into tomorrow. Physical doesn't have tomorrow. Physical is deliver or fail. So this is what happens in bifurcated markets. Shanghai rises first. The paper market in the West resists. The gap between them grows. That gap then drains physical metal from west to east. This drain weakens the paper market's ability to pretend it's in control. Then, suddenly, the paper price jumps violently to slam shut a door that was already broken. That jump is the real story. You're not actually seeing the move happen in real time. You're seeing the delay. And right now, that delay is ending. Because every single day the gap persists, more physical metal flows east. And every ounce that flows east is an ounce that can't be delivered in New York or London. This is the core mechanic of the drain. And it's accelerating. In part 3, we're going to explain exactly why Shanghai is now the real price discovery mechanism for silver, and why the number you see on your screen from Western exchanges is becoming increasingly irrelevant. Stay with me. We're going straight into the heart of the matter. All right, welcome to part 3. We've shown the time compression. We've explained the arbitrage gap. Now we need to understand why Shanghai is the real market and why New York is increasingly just theater. Now let me give you the framework. In a surplus market, the paper market sets the price. Why? Because there's more metal available than there is demand. So the price on the margins is determined by speculators, by traders, and by financial flows. Paper dominates because the physical supply doesn't act as a constraint. But in a deficit market, the physical market sets the price. Why? Because now there's more demand than there is available metal. So the marginal price is determined by whoever needs that metal most urgently. And that's not speculators, that's industry. And where is industry concentrated? In Asia. China manufactures over 80% of the world's solar panels. China is the largest producer of electronics. China is building out massive 5G infrastructure. China needs silver. They don't just want it. They need it. So when Chinese buyers bid for physical silver, they're not just trading for a quick profit. They are securing essential supply for production lines that absolutely cannot stop. This is why Shanghai matters. Because Shanghai is the place where physical demand that cannot be delayed meets physical supply that cannot be expanded quickly. That is real price discovery. New York, by contrast, is where paper contracts trade based on leverage, margin, and speculation. And paper can be created infinitely. You can sell a futures contract for silver you don't actually have. You can create synthetic exposure through options. You can roll your positions forward month after month. Paper is elastic. Physical is not. And when the physical market gets scarce, the paper price becomes a lie. It's a convenient lie, sure. A lie that lets big banks pretend they still control the price. But that lie is being exposed, and the exposure is happening in Shanghai. Because Shanghai is saying, we will pay $75, $76, $77 for immediate delivery. And when someone offers that price and holds it there, they are revealing what physical silver is actually worth. Not what the paper market wants you to believe it's worth. What it's actually worth to someone who needs it, right now. This is the most important concept to grasp. The real price isn't the lowest price someone will accept in a slow market. The real price is the highest price someone will pay when they have no other choice. And industrial buyers in Shanghai, they have no choice. They need the silver, so they pay. And their payment sets the real price. Now here's where it gets interesting for tomorrow. If Shanghai is already at $75 or $76 today, and the gap hasn't closed, and the physical flow is still constrained, what happens tomorrow? Does the premium just collapse? It can only collapse if a massive new supply suddenly arrives. But that supply isn't arriving fast enough. So the premium stays, or it widens. And if that industrial demand is still urgent, if someone needs 500,000 ounces for a production run that starts on Monday, they don't wait. They bid higher. They'll go to 77, then 78, then 79 if they have to. This is how a price discovers its real level in a physical market. Not through charts and technical analysis, through desperation. And here's the brutal truth. Once Shanghai establishes a new, higher price level, New York eventually has to follow. It has no choice. Why? Because if the gap gets too wide for too long, the paper market loses all credibility. If Shanghai is trading at 78 and New York is stuck at 71, and that spread persists for days, the entire market starts asking a very dangerous question. Which price is real? And when that question spreads, confidence in the paper price collapses. Traders stop trusting COMEX. Investors demand physical delivery. The whole system comes under stress. And that stress forces New York to gap up, not gradually, suddenly, in one violent repricing that catches everyone off guard. This is the mechanism. Shanghai leads. New York resists. The gap widens. The gap drains the metal. The drain forces New York to acknowledge reality. And reality is always higher than the paper market wanted. In part 4, the final chapter, we're going to explain the $75 to $80 trigger zone. We'll look at why this specific range is where gamma mechanics and industrial panic collide, and why that collision can take us from $71 to $80 faster than most people can even process. Stay with me. We're going into the catalyst. We've reached the final part. We've shown the compression pattern. We've explained the arbitrage gap. We've detailed why Shanghai is the real market. Now we need to talk about the trigger zone, that $75 to $80 range, because this is where mechanical forces and human panic converge, and when they converge, price doesn't just move, it explodes. Let me start with the gamma mechanics. I'm going to make this simple. No calculus required. Just logic. Round numbers matter. $75 and $80. They matter psychologically and they matter mechanically. In the options market, massive amounts of call options are clustered at these strike prices. Why? Because traders and speculators love round numbers. They buy $75 calls. They buy $80 calls. And when they buy those calls, someone has to sell them. Usually that's the market makers, the big banks, the institutions that provide liquidity. Now, when a market maker sells a call option, they have exposure. If the price goes above the strike price, they lose money. So what do? They hedge. They buy futures contracts to offset their risk. This is called delta hedging. And here's the key. The closer the price gets to the strike, the more they have to hedge. At $70, the probability of hitting 75 is moderate. So they might hedge 30% of their exposure. At $73, the probability increases. They hedge 50%. At $74.50, they're hedging 70%. By the time the price actually hits 75, they have to hedge 100% of their position. But here's the problem for them and the opportunity for us. Their hedging is buying, and their buying pushes the price higher, which makes the next strike level, $80, even more probable, which then forces even more hedging for that level. This creates a powerful feedback loop. Price rises, hedging increases. Hedging pushes the price even higher, which requires even more hedging. This is gamma, and it's purely mechanical. It doesn't care about fundamentals. It doesn't care about sentiment. It just executes. So when the price enters that $75 to $80 zone, gamma becomes the dominant force. And once gamma takes over, moves accelerate. You don't get $1 a day, you get $3 a day, or $5 in a single session. Because the hedging is forced. It's not voluntary. It's just risk management. And risk management in a rising market means buying. Lots and lots of buying. Now add industrial panic to this equation. At $75, industrial buyers who were hoping for a pullback realize it isn't coming. At 77, they realize they're behind the curve. At 78, they panic. They stop waiting. They stop hoping. They just buy. Because every day they wait, the price is higher. And every dollar they try to save on price, they risk losing on delivery delays that could shut down their factories. So they bid. Aggressively, they call refineries directly. They call miners. They bypass the exchanges. They do off-market deals. They pay whatever premium is necessary. They lock in supply at any cost. Because the cost of not having silver is infinitely higher than paying $2 or $3 extra per ounce. This is inelastic demand. And inelastic demand doesn't create trends. It creates jumps. So now you have two incredibly powerful forces converging. You have gamma hedging from the options market, and you have industrial panic from the physical market. Both forces are buying, both are urgent, and both are operating in a market where available supply is severely limited. What happens? The price doesn't climb. It explodes. This is why $78 in Shanghai tomorrow is completely plausible. Because if Shanghai is already at 75 or 76, and these forces engage, the move from 76 to 78 can happen in hours, not days. And once 78 prints, even briefly, the entire psychology of the market shifts. Sellers freeze. Why sell at 78 when it might be 80 tomorrow? Buyers chase. I need to get in before it hits 80. And the self-reinforcing spiral accelerates. This is the trigger zone. This is where markets break from linear behavior into exponential behavior. And we are entering it right now. Now, let me give you the whole argument in clean pillars so you can see the entire thesis at once. Pillar 1, time compression. The $10 moves went from 39 days to 12 to 13. That suggests the next $10 move can be even shorter, especially with this arbitrage running. The pattern is acceleration, not stabilization. Pillar 2, the magnet. When the east pays more, the metal flows east. As metal flows east, the west tightens. That tightening forces the paper price to jump. This is the drain mechanism, and it's relentless. Pillar 3, $75 to $80 is a trigger zone. Above this band, hedging mechanics and industrial panic collide. That's when price moves in vertical stair steps, not gradual trends. Conclusion for tomorrow. If the market already accepts Shanghai as the future price, then $78 or higher is simply the future arriving faster than Western paper markets can keep up. And here's the critical point. This isn't about hoping for 78. This is about understanding that if the current conditions persist, 78 is the logical outcome. Not because of manipulation, not because of a conspiracy, because of mechanics. Physical scarcity plus time compression plus gamma hedging plus industrial panic equals explosive price discovery. That's the equation. And every variable in that equation is active right now. So let me give you the 5-point checklist. What to watch in the next 24 hours to validate this thesis. Because if you watch the right signals, you'll see the move coming before it prints. Point 1, the Shanghai versus West spread. Is it widening or shrinking? If Shanghai opens at 76 or 77 while New York is at 71, the gap is widening and the pressure is building. I've been telling you for weeks that the game has changed. I've shown you the charts, the data, the arbitrage gap. But many of you are still glued to the New York price, cheering for a 50-cent rally. Tonight, I'm going to give you a 5-point checklist. This isn't theory. This is a real-time monitoring plan for what could be the most explosive price move of the year. If these 5 signals align, you'll know the reset is imminent. First, the Shanghai drain. Forget the daily noise. Look at the weekly and monthly withdrawal data from the Shanghai Futures Exchange Warehouse. Is the total inventory number consistently dropping week after week? Is the rate of that decline speeding up? A faster drain means physical demand is outstripping available supply, right at the heart of the world's biggest physical market. That's the foundation. Second, watch the physical premiums. This is crucial. Let's say the paper price, the spot price you see on your screen, pulls back to $70. But when you call a dealer to buy the actual metal, they're still charging $85. That gap, that premium, is the physical market telling the paper market, we don't believe your price, we're not selling for less. When premiums stay high or even rise as the spot price falls, it's called decoupling. The physical market is breaking away, refusing to follow the paper contracts down. Third, look for signs of delivery stress. This is where the system starts to creak. Are delivery wait times getting longer? Are dealers who used to have metal in stock now moving to a pre-order only system? Are they taking prices off their websites and forcing you to call for a quote? These are all methods of rationing. They're trying to manage a supply shortage without openly admitting it. And rationing is always the step right before a panic. Fourth, pay close attention to what happens at the $75 level. Does the price touch 75 and get immediately slammed back down? Or does it touch 75 and stick? If it can hold that level, even for a few hours, it's a huge signal. It means the sellers who were trying to suppress the price are exhausted. They've run out of ammo. And if sellers are exhausted at 75, there's practically nothing stopping a move to $80 except for some automated hedging flows. And the fifth and final signal, fast moves in thin liquidity. Are you seeing sudden, violent price jumps on the chart? A move from 73.20 to 74.10 in just 30 seconds, with no visible trades in between? That's what a liquidity vacuum looks like. It happens when there are far more buyers than sellers, and the order book is so thin that a single large buy order can chew through all the available sell orders and send the price soaring. If you see these 5 signals firing at once, the market is screaming one word at you: scarcity. And scarcity doesn't cause gentle, orderly trends. It causes violent upward resets. The bottom line is this: you can keep watching the New York price and get excited about pennies. Or you can watch Shanghai and understand the one unbreakable rule that governs every market in a deficit. Physical demand eventually pulls the paper price with it. If Shanghai prints $78 or higher tomorrow, it's not just another rally. It is a warning shot. It's a message that your screen price is lagging behind reality and the real metal has already moved to a new price floor. And when that gap between the physical and paper price gets too wide, the market doesn't correct slowly. It snaps back in one single violent move. That move could be tonight, it could be tomorrow, it could be next week. But it is coming. That arbitrage gap is not sustainable. Either a flood of new supply has to arrive from the West to close it, which seems incredibly unlikely given all the supply chain issues we're seeing, or the Western paper price has to jump to meet the Eastern physical price. That isn't just likely, it's inevitable. The only real question is timing. And based on the patterns we're seeing, the time is now. Not months from now, not even weeks from now. We are talking days, maybe even hours. So here's your action plan. Watch the Shanghai market open tonight. If it opens firm at $75 or higher, the thesis is live. Watch the spread between the Shanghai price and the New York price. If it gets wider instead of narrower, the physical drain is accelerating. Then, watch New York's response. If the paper market tries to smash the price down and fails, it means the manipulators have lost control. And then, watch for the jump. Because when it comes, it won't be a $1 move. It will be $5 or $7 or even $10 in a single session. And by the time you see it on the news and try to react, the move will be over. This isn't fear or hype. This is simple pattern recognition combined with a mechanical understanding of how these markets work. The market is telegraphing what's coming. The price compression is visible on the charts. The arbitrage gap is measurable. The trigger zone is clearly defined. And Shanghai is about to show the world what the real price is. Not the price that paper traders want you to believe, but the price that physical demand requires. And that price is higher, much higher. Make sure you're subscribed because the next 72 hours won't be about analysis. It will be a live scoreboard. We'll be tracking every tick, every premium, every signal. And when $78 prints in Shanghai, we'll know exactly what it means. It won't be a time for celebration. It will be a time of confirmation. Confirmation that the paper market has lost control and the physical market is now setting the terms. The arbitrage gap is the story. A $78 print is the proof. And tomorrow might just be the day the world wakes up and realizes the price on their screen was never real. It was just the last number the banks could defend before physics took over. Don't get caught watching the wrong market. Don't anchor your expectations to outdated numbers. And do not underestimate what happens when the East stops accepting Western paper prices and starts demanding physical reality. The future isn't being decided in New York. It's being decided in Shanghai. And Shanghai opens in a few hours. Watch closely. If you got value from this breakdown, please hit that like button and subscribe to the channel so you don't miss a single update during this critical time. Thanks for watching.